All right, well, the market has reacted to these comments from the U.S. Fed Chair Jay Powell in the last 20 minutes or so, with Powell saying the time has come for the U.S. Federal Reserve to start cutting interest rates, saying that cooling in the labor market is unmistakable, adding that they don't seek further cooling of job market conditions, and that on the inflation fight, that right now that is on a, quote, sustainable path back to the Fed's goal of 2%. That has set the stage for an official pivot by the American Central Bank starting at their September meeting. Let's get more insight now from Tom Porcelli. He's chief U.S. economist at PGIM Fixed Income and one of our great regular guests. Tom, nice to have you with us. We didn't know what direction Powell would go today. He seemed to at least try to be pretty clear with the September plan. What was your reaction?
Yeah, I think you nailed it, by the way. I think those two quotes that you pulled from his speech, I think that says it all. I mean, this is clearly a Fed chair that wants to get on with this. In fact, not only do I think he wants to get on with this starting in September, but I think that, I think a lot of people were sort of wondering about the cadence of rate cuts to come. This strikes me as a Fed chair that just wants to start. Once he starts cutting, he wants to keep cutting. So I think the journey to getting to some semblance of neutral, call it 3 to 3.5%. I don't know that this is going to be something that you have to wait to get to by the end of next year. I think that this could happen relatively early in the coming year. So I think this will be a pretty aggressive easing cycle in terms of, this could easily be an every meeting cadence.
Let's just talk about that for a second, because I think for anybody who's trying to get a firmer picture, like I had seen some trader positioning ahead of this speech today that almost suggested there's a good group that would have not been surprised to see upwards of 100 basis points worth of cutting by the end of this year. I do think that that number was reduced a little bit from where it had been even earlier this month. But if you had to guess, September through the end of the year, how many rate cuts do you think we could see?
Yeah, so I'm looking at market pricing right now. It looks like market is pricing in about a 33% chance of a 50 basis point cut in September. I have a lot of sympathy for that idea. I think what does it take to get you there, though? Like what would it take for the Fed to start with a 50 instead of a 25? I think that really comes down to the payroll report. I get it. The Fed keeps on saying that, they're not data point dependent, they're data dependent. But the reality is we've heard from a number of Fed officials, even over just the last couple of days, who keep on saying they're waiting to see what coming data suggests. So I think if you get a really poor payroll report, right, a really weak payroll report, I think that could easily put a 50 basis point cut on the table, fully on the table, for September. But again, that's the hurdle. The hurdle is you need to see a weak payroll report. And that's what it would take to get to 50, right? There's only 3 to 100, I should say, by the end of the year, which is what the market is pricing. There's only 3 meetings this year that remain, the September, November, and December meetings, right? Because it's every 6 weeks. To get to 100 basis points in cuts, you would necessarily need a 50 at one of these meetings. And again, I think the tipping point for that is you get weak labor data. I think that's the thing that gets you there.
All right. I'm going to throw something else out there because we literally just did a stock market segment with Ken Fisher where he talked about how, he talked about central bank stuff, but he also then talked about the election. There was a narrative for a while out there that it gets complicated for Jay Powell if they haven't embarked on the rate cutting cycle once we're getting closer to November and all that kind of jazz. Any thoughts on how the Fed has to navigate moving into a pivot period when everybody's talking about an American election and the economy's in focus there too?
Yeah, I think this is a really important question. And I want to be very, very clear with everyone on this point. History is littered with examples of the Fed adjusting policy, not just in an election year, but in and around election months. All the Fed needs as support for that is data that definitively suggests they are supposed to adjust policy. So I don't think the election gets in the way at all. I mean, we went back to the 1984 election and looked at every single election from 1984 onward. And the historical record is pretty clear on this point. The Fed adjusts policy around elections when the data demand that they do so. So I think this is no different this time around.